Hi everyone, Billy here, the co-founder of Trade Prosper, and welcome to section 11, video 1. How do we trade trends using options? Now, when we talk about using options as part of trend trading, it's important to remind you that we're talking about options as a replacement instrument here. We are not going to look at options as trading instruments by themselves. So when we look at this, we are really just talking about a mindset and the decisions that we are faced with at inception of a trade. So when we get to the point where we've done our analysis and are now ready to pull the trigger on the trade or put an order in the system, we have two decisions that we need to make. The first is we want to decide whether or not we want to use a strategy that's going to smooth out the ride for us. In other words, we want to try and avoid being stopped out too soon. And the second decision is, are we going to trade the underlying directly, or are we going to use options to supercharge that trade? So this particular section of the course will just focus on, do we want to avoid being stopped out too soon? So the important thing to remember with trend trading strategies is that we are not trying to catch a top or a bottom in the market, but instead we are trying to identify a trend, join the trend, and then ride it for as long as the trend exists. So what this does is it takes a lot of pressure away from us. We don't have to sit there and watch the markets the whole day. In fact, most of the strategies that Mike have spoken about showed you how you do your homework and you put the entry orders in, and then you wait and see what happens in the market. So what we're going to be doing is to emulate that very same process. We don't want to really add to your decision-making process. We want to just complement it using the option strategies that we're going to speak about. Now, Mike spoke to you about a couple of entry techniques. The first is when the price of the instrument crosses a moving average. The second one would be where two moving averages crosses each other. And the third strategy would be a breakout technique where the price breaks out of the levels, high or low levels that we've seen over a predefined period. So what I'm going to look at now is we have to understand that in each one of those techniques, there were decisions driving us to the point where we said, okay, now it is good for us to put an order in. And from here, we're going to see if the trend actually materializes the way that we anticipate this to do. So when we introduce options to this equation, we're actually going to follow the exact same planning and analysis process as before. So in other words, this is not something new. This is completely complementary to what you will be doing in any event. There are no new rules that we're going to add. Remember, we're not looking to trade the options in the traditional sense of the word. We're actually looking to use options as an extension of the technique or the process that you're going to be trading in any event. So let me explain what I mean by this by looking at one of the three techniques that Mike taught you. And for this particular example, I'm going to use the 55-day breakout technique to show you that everything that you would have done up until that point remains in place. And it's only at the end of the decision-making process that we're going to add something new to this. You will recall from Mike's sessions that in order to do a 55-day channel breakout strategy, we had to look for a couple of things first. The first thing is we had to have a sideways setup happening. The second one is a blue ADX, and this is very, very critical. We're not going to put any strategies in place anticipating a move. So what I mean by that is, we're actually going to put stuff in place once the edges have already appeared. And when I say edges, remember what we're trying to do is we're trying to eliminate any uncertainty. So when an ADX says to you that it's turning blue, the trend is strengthening, to us that is considered an edge. We are now looking into the market. We have some insight behind this move, and the move says there's a good chance that this trend will strengthen from here or continue from here. And then the price action needs to be close to either a 55-day high or a 55-day low. Once all those three conditions are in place, you now start paying close attention to that particular market. And at this point, you now start evaluating what the strategy is that you will take from here. So now, only once this is done, once you've identified those three steps in this particular example of a 55-day breakout, this is the only point where we now add one more choice into the decision-making process here. We've agreed that the sideways setup is in place, so we're about to now embark on the trade, or at least putting our orders in the system to try and catch this trend. So at this point only do you now have the two choices to make. Do we trade the underlying and continue the exact way that Mike has shown you up until now? Or alternatively, shall we look at options to perhaps express this trade? Now, in this example, we're going to obviously look at using the options. And once you've now decided you want to use options, again, there are two strategies that you have to think of. The first is, are we going to use options to avoid being stopped out too soon? So in other words, are we trading a market that's fairly volatile and we don't want to run the risk that we caught the trend or we called the trend correct, but as a result of our risk management strategies, the stop loss gets triggered before we actually get the benefit of the trend materializing? Or the second point is, are we going to use options for the leverage benefit behind this? In this particular video, we'll cover just the first example. So in other words, how do we avoid being stopped out of this trade? Now, which option do we use? Remember, we're only looking at one example at the moment. We're looking at the 55-day channel breakout trend trading technique. Now, the concept behind all of this is exactly the same. Whether you are trading a moving average crossover, whether you are trading a price crossing the moving average, or whether you're trading a channel breakout technique, the decision making is the same. If you think that the break will be to the upside, so the price breaking towards the upside and the trend will continue with prices increasing, then you'll buy call options or you'll use call options. If your decision making brings you to the point where you think price is going to break to the downside, in other words, a downward price movement, you'll be using put options for that trade. Now, once again, the point here is to avoid interim spot volatility, because it's the volatile nature of prices that we are protecting ourselves against, right? That's the purpose of the stop loss. So having the stop loss in place is saying, hey, listen, we've done all our homework. We think this trade's going to materialize, but just in case we are wrong, we need the market to automatically close our position if the trend does not materialize the way we are doing or the way we're looking for it to happen. Now, remember, once again, there's going to be numerous occasions where you call this wrong. The trick is not being right here. The trick here is to follow your system and your risk matrix. So expecting and knowing that you might be wrong, that's the reason why we have stop losses in place. Now, what happens is when you start trading for a while, you realize that the market doesn't care about your positions. They don't know that you have a stop in place. They don't know that you have an order in place. The market just trades. So it's our job to figure out what's going to happen. So the point of having a stop loss in place is to reduce the risk of our position running away from us and also to take the emotion out of it. We don't want to sit there and wonder, is this trend now really going to happen or not? But what often happens is the market materializes in a way, or the trend materializes in a way that we didn't expect. So it first might actually stop you out and then the trend continues. So in an effort to avoid this interim spot volatility, what we're looking at is to add some time into the process. Because think about this now for a second. If I can give your strategy time and I say for the next 45 or 60 days, we don't really care what happens to the spot. The spot can go up and down, but remember the strategy we are trading is a trend trading strategy. So we're thinking the point that got us to this decision to put this order in is identifying the possible nature of a trend that materializes. Now, we've seen that the trend doesn't happen or the trend doesn't crystallize in day one or day two. Sometimes it does, but more often than not, it takes a couple of days to get to that point. And I mean, that's the purpose of a trend trading strategy. We want to identify the trend before it's too late and you've missed the boat. So by adding 45 to 60 days to this discussion, we can ignore what happens to the spot in the interim between the 45 days and the 60 days. Because what we're going to do is we're going to say, okay, let's buy a call option struck at the same rate or very close to the original breakout level. So remember, our decision-making point is here. At this day here, we enter into the call option. Because remember, why is it a call option? Because the market's breaking to the top side and we think the prices will increase. So we want a call option to express this view. But by entering this decision here on this day here, we now add 45 to 60 days. That's the type of period that you would look at trading this option for. And we don't have to look at the spot market at all in between this time if we didn't want to. Now here's probably a good point to introduce the following concept. Remember Mike showed you that you can have short-term trends and longer-term trends. So for example, if you do a 10-day crossing over a 20-day, that's a short-term nature. So you're trying to catch the short-term trends that exist in a very big trend that might occur. or in our example that we're running through now, a 55-day strategy is a longer term strategy. So when we look at options to complement this particular trade, we're going to try and match the option day count to the general feel of the strategy. So if we're doing a longer term strategy, like a 55-day crossover, we're going to be doing longer term strategies. If this was, for example, a 50-day moving average crossing a 100 or a 200-day moving average, the two moving averages crossing, we would even put a longer dated strategy or longer dated option in place, because match the option tenor that you're going to use to the general reason what you are trying to express here. So if it's a short-term trend, use shorter term options. If it's a longer term trend you are trying to catch, use longer term options. All right, so back to the example here. This is a 55-day channel breakout example. So we're going to look for an option that has an expiration around about the same time, so 45 to 60 days. By entering into a call option at the same level or very close to the same level as that original breakout level. Now remember, I want to remind you here, we're not looking back in time. We are actually standing at this point here currently, and we're putting the option on today. So we know where this level is. And as we show you, we don't have to be critically watching the market at any point in time, and as soon as it breaks this level, we put our option in place, because we're catching a general trend. So once again, you can observe the markets at the end of the day, once a day, twice a day, doesn't really matter. The point being is, on this day, we saw it break out through the upper level of our channel, which to us indicates an upward trend, and we now want to buy a call at or about the same level of where this breakout occurred. Whether you're off by $1 or $2 is completely irrelevant for the overarching concept of what we're talking about here. All right, so now we bought this option. We now own a call option, let's say 45 days from here. We've basically now put a line in the sand and said we will observe this strategy in a month from now and see what has happened. Did the trend materialize or did it not materialize? Now remember, we do have different types of strategies that's not that complacent. So what I mean by that is, in some cases, it's not the best thing to just wait completely for these things to happen. You might actually want to, once this trend doesn't materialize, just sell the option back. But that's a discussion perhaps for a different course. I mean, the overarching concept at this point is just to show you the flexibility of how options can be used here. All right, so now we've entered into this call option for 45 days. Let's use 45 days as an example. And where that star is now our strike rate level. So let's look at two possible outcomes here. Let's just say the spot in this example continues along the direction of our trend. So in fact, we were correct in trading this, catching this trend. What does owning a call option do for you? Now, when you own a call option, you've effectively crystallized the rate at which you can buy whatever security that you are trading. If it's a share or if it's a currency pair, one of the currencies, you now have the right to buy at that level. If you're a purchaser of the option, you have all the time in your favor. So in other words, you can wait right up until the option expires to decide what you want to do with it. Not that you want to, or not that you have to. In some of our other courses, I show you how to dynamically manage your position over time, which is sometimes a little bit more efficient. But for purposes of what we're trying to achieve here, this is perfectly all right to just use options and look at them in this particular case, because we're doing trend trading strategies where we want to catch a big move. You can look at them at the end of the period. Because also, remember, we're not forgetting our risk parameters here. We'll still keep that exposure in line with our 1% capital or 2%, whatever your particular risk profile is. But in this instance, let's just now look at this. We've now crystallized the rate at which we can purchase this particular instrument. And this is in 45 days from now. So the benefit here lies as follows. Look at what happens to spot. Now you can see first and foremost, spot went lower. But what happens now is we can basically close our eyes, go to sleep, wake up again at maturity 45 days later and just see where is the spot now. And look how nice this is. The spot materialized into the trend that we thought it was going to be. And now we exercise the option and we can just bank all the benefit between where our original strike was, which was our original entry level, and wherever the spot is at that time. So once again, there's a couple of choices you can make. You can cash in the option itself if you think the trend's done. You can cash in the option itself and just take the money. But when doing trend trading, remember, we're not trying to just take a predetermined profit off the table. We want to catch this trend, because this trend can continue for years. Like I recall the one example that Mike showed you where the trend was happening for 2 years. So by you taking the option profit off the table, perhaps you're actually shooting yourself in the foot. Now, once again, you can take half of it off, or alternatively, what you can do is just physically at that point buy the underlying instrument. Now, what does that do? It puts you in the instrument at the same level that you would have been in had you just traded the underlying trend trading. And what you've done is you've actually now given yourself this convenience or this cushion to say, I'm back in at the level where I thought the trend was going to materialize. I ignored all the interim spot movements up until then. Now let's just evaluate it. And guess what? At this point, your exit strategies, now that you're along the same instrument, the actual instrument, you now just kick on, or you now just switch on the exit strategies that Mike has shown you. So I want this to be clear. You didn't use the option here to trade the option. You've used the option to say, I'm looking to capture the trend. The trend has materialized, and I'm now in the trend. And once you're in the trend, the exit strategies are the ones that Mike has shown you. So once again, nothing new to understand or new to do here. So let's look at what would happen if the spot does not move in your favor. Now in this example, the spot went up, and by the time we get to our 45 days, the observation level is lower than the strike level. Now remember, if you were just trading the trend with the underlying directly, you would have also been stopped out. So none of these positions would be left to chance just like that. But the nice part about an option is we know upfront what that stop loss risk is. So remember, when you buy an option, you pay a premium for it. That premium is the only risk that you will ever have towards this trade. So in this example, when we get to the end of time and there is no reason to exercise the option, guess what we do? We let the option expire. We don't care. There's nothing to do, so there's nothing to do. And the maximum loss that we have paid or attributed to this trade, we knew all the way up front when we entered into this transaction. And that premium then would have been part of the risk management we've done back in the day. And once again, it shows you the convenience here. It allowed you to say, listen, let's see if the trend unfolds. And in this example, the trend did not unfold. But again, we weren't left open to chance. We actually had our stop loss well in place. And in this example, though, the stop loss is just the premium that we have spent up front. All right, so after all this is said and done, there are 2 questions left. When you get to the point where you decide, I wish to use an option in this strategy so that I can avoid being stopped out or buy myself the time to see what happens with the trend, the 2 questions that you still need to ask is, which strike rate do I choose? And also, how much premium should I spend on this strategy? We will cover both these questions in the next video. I'll speak to you then. Bye-bye.